that you could take out the time to speak with us at this hour. Um, how bad is it looking globally? I know it was largely a weak week, but do you think it's a prelude to perhaps more skepticism coming in with what's happening on oil prices, on the macros, trade talks between the US and China, US, Korea, US and the world? What's happening there? Are you more circumspect about, global cues going forward into the near term?
Well, let's talk about. There's a few issues going on. One is obviously the oil market. Second is, and I think even more important, is what's going on with the U.S. bond yields. And I think the U.S. bond yields are sharply moving higher, and they're moving higher not because of oil prices, but because of U.S. growth being solid and U.S. unemployment being at record low levels. And therefore, the expectation is that the Fed is going to be on a tighter tightening cycle than, or a stronger tightening cycle than people had assumed a few weeks ago. So as long as that economic underpinning remains solid, that's upside. On the other hand, there's a concern that the trade war between U.S. and China will cause some inflation feedback into the U.S. economy. But that's causing major sell-off in China and other emerging markets. So the emerging markets are facing 2 or 3 different headwinds. One is the trade war and the impact on global trade and therefore on different economies and different currencies. Second is the impact of a tightening, faster than expected tightening in U.S. rate cycle and the impact that has on funds flows and therefore again on currencies. And the third is oil prices. And unfortunately for India, it doesn't get as badly hurt on trade, but it gets hurt badly on oil prices. And in a current account deficit situation, when funds flows are turning negative, it gets hurt on the currency. So I think that trade is a half negative for India. The other 2 are full-on negatives, and therefore those are 3 things that are negative. And then you add a fourth, which is completely domestic. And the domestic problem is that as a result of the ILF NFS collapse, even though there's a rescue going on, it has significantly tightened financial conditions for NBFCs and therefore for the Indian economy. And that is bad news that the market needed like a hole in the head right now. And therefore, with all of that in place, I think RBI was caught between a rock and a hard place, and RBI is unfortunately having to make the choice of not raising rates, and there's no good answers. Not raising rates means probably more pressure on the currency. So I think right now, the confluence of bad news, continues unfortunately on many fronts.
Right. Arvind, on a domestic front, do you think after almost $1.5 billion of FII pullout already month to date we've seen, there's added concern on whether or not India is going to be able to maintain the fiscal math or not? Because just last week you saw the government move an excise duty, and it's a big cut that they've actually announced, almost 5 rupees to a litre on both petrol as well as diesel. And do you think the kind of burden that it would bring about on the fisc, that's also an added concern at this juncture?
Unfortunately, you're absolutely right. I missed that part. That is the other negative, is the fiscal deficit. There are no easy answers. And if I didn't talk about inflation, but oil prices obviously and weaker currencies obviously inflationary. And if you're going to try to offset that by taking on more fiscal burden, then the fiscal deficit is going to go for a toss. And already we are seeing, the collections on GST running below expectations, and that's before the effect of all the other factors on economic slowdown, and therefore the fiscal is also going to be challenged. So I think that's another negative. So unfortunately, what we are going to get in the next few days and weeks is great earnings from the September quarter fiscal second quarter numbers, but they're going to be treated very much with skepticism because they're backward looking, and the forward looking outlook is much muddier and much more clouded, and therefore I think that is going to be the macro is a dominant theme. And you've talked about FI outflows. I think at this point, the biggest problem for India is not going to be, the Indian markets is not going to be FI outflows. At this point, the biggest negative is going to be DII outflows. And there is, in my opinion, almost no way that you're not going to see, in addition to whatever margin calls and other pain that HNIs and others are facing, is the SIPs and others are likely to see, when people get their statements and see the kind of losses that they've suffered year to date and over the last 12 months, particularly in the mid and small caps. I think that could turn negative. And if that starts to turn negative, which it's very, very, human nature would have to change for it to be different this time. Almost every time in history when this has happened, you've seen, savings move out of the market. And especially as, bond yields tighten and better returns are available without taking less risk in other instruments, then I think that'll provide another headwind for the market.
Oh, yes, absolutely. It's easier said than done that buy the fear, but I don't think it's going to be that easy. And for a market which all of 2017 just boasted about the DII flows, we're definitely headed in for a big challenge. So, Arvind, as an investor, what's the messaging? Do you buy the fear, or is the message loud and clear? Don't try and catch a falling knife. Just stay away on the sidelines, keep the powder dry if that's a possibility at all. Profit take from wherever you have been making money, and try and wait for the poison to get out of the system as much.
Well, I mean, I think one has to be very selective in buying companies that are going to be able to navigate this well. So, some of the private sector banks will be winners because of the dislocation that already you had on the PSU banks, and now you have the problem with the NBFC. So some of the private sector banks could be winners, but again, they're going to get a little cheaper. But that would be an area I would see opportunity. Stocks like Reliance have sold off a lot, and they clearly have some exposure to oil marketing, but that's a small part of the exposure. So at some point, those and other companies that are more, dollar earners and benefit from lower domestic costs, those could be winners. So again, one has to be selective because there's been a lot of money hiding there. But I think anything that's a domestic demand story, whether it's consumer or it's business demand related, is going to be looked at with skepticism by us, and I think it should be by others because that demand outlook right now looks somewhat challenged. And at some point, the valuation will get attractive enough that we can look through any weakness coming. But I'm not sure that we're there yet.
Arvind, what about the mess in the financial sector in India? I mean, especially with, whether it's leadership transition, whether it's about asset quality, whether it's about corporate governance, the NBFCs, where is it that, you would believe value would emerge as the cleanup happens?
Well, I mean, I think NBFCs has been the best performing part of the market for several years now. The leadership in the next cycle is not necessarily going to come from NBFCs. It doesn't mean that some NBFCs are not oversold and could be interesting plays from a value standpoint, purely from an oversold value standpoint. But in terms of overall market, kind of favoring, I don't think, the macro outlook for the NBFCs is likely to remain challenged for some period of time. So I think we'd be much more careful about certainly being overweight NBFCs, which was kind of the lazy long approach in the last few years.
But if I were to ask you to stare at the crystal ball and give us your own assessment, because we've had some of the most influential investors like Ray Dalio as well as Howard Marks call for caution into 2019. Do you think that we are getting into a tougher phase for the markets where generating returns would be tough? That is one thing, which has been a character for 2018 as well. But other than that, you're also contesting with the possibilities of risks that can trick the market on the downside.
Well, yeah, I mean, you're absolutely right that we are entering into a phase of the market where, there are more headwinds than tailwinds, and therefore I think that this is not a time to be overly ambitious and overly aggressive. I'm afraid that the bull market run that we have had over the last few years is going to take a serious breather here for some months to come. I can't call all of 2019, But in a market like India, 2018 is already, already Nifty is only down 2 or 3% in local currency terms, but with the currency down 15%. For FIs, it's down a lot, but for local investors, the mid cap and the small cap are down, 20%, 15, 20, 25%. And therefore, I think that, unfortunately, Indian valuations relative to historical norms are not cheap by any stretch. Therefore, that is an important point to keep in mind, that if we are going into a meaningful correction, leave alone a full-fledged bear market, you want to make sure that if you're stepping up, then you're buying at at least historical means, if not well below historical means, and we're not there by any stretch.
Arvind, an absolute pleasure speaking with you and getting your perspective in. And once again, thank you very much for staying up this late to speak with us.